Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to be talking about dividend stocks that I'm potentially adding to this portfolio. Right now, we have 30 stocks in the portfolio, and I've been talking with some of you guys in the comments, and I've been trying to decide what stocks should I add to this portfolio. So I'm going to be looking at some of the top 4 stocks specifically that I've been watching, and I'm going to get your guys' opinions down in the comment section on what I should be adding, if any of them, and should I be changing any of my investments for these top holdings and some of these middle holdings down here to compensate for that? So as usual, to get started, we're going to give you an update on my portfolio. For the day, we are up in the green. We're up 0.29% or about $4.97 in market gain. And in total, we're up 9.72% with $149.56 in gains, $147.09 coming from market gain, and $2.47 coming from earned dividends. And as usual, we talk about the earned dividend as more important because we are using a dividend growth portfolio. If you enjoy watching my videos and you're interested in using M1 Finance, make sure to use this link down below. It's in the description, and we can each get $10, and I'll put that towards my dividend stock portfolio, and I'll make sure to mention you in the video. So my biggest gainers in the portfolio are still some of the same, such as Cisco, Whirlpool, NextEra Energy Partners. They just reported earnings. And NextEra Energy just raised their dividend. They raised it from 53.5 cents a quarter up to 55.5 cents a quarter. So I'll be increasing my annual income there. And my biggest losers in the portfolio are Wells Fargo and Caterpillar and Altria Group. I'm now still up on all 30 of the stocks I own, and Wells Fargo and Caterpillar are back in the green, so all 30 are in the green, so that's good to see. So let's jump right into the first stock. So the first stock that I'm potentially looking at adding to my portfolio is TGT Target Corporation. So there's a couple reasons why I'm considering adding Target. I thought about adding it a little while back, but it had a huge spike up with a huge earnings report. They did just raise their dividend a couple months ago. And Target is a stock that is a very safe long-term growth story. So one thing that I want to show with Target here, so let's look at the last 5 years. They're up 30.4%. Usually Target is primarily compared to Walmart because they have such similar business models. If you look at their dividend history here, 5 years ago they paid 52 cents, then they were up to 56, then they were up to 60, and then 62, and then 64, and now they're up to 66 cents, and I believe they're due for a dividend raise in a couple months. So Target sells anything much like a Walmart, from basics such as groceries to clothes to electronics, anything that's basic that you need that is pretty much involved on your grocery list. So one reason why I wanted to add Target is that if we look here, so I'm on suredividend.com, and we're going to look at Target being a dividend aristocrat. To be a dividend aristocrat, you need 25 consecutive years of dividend raises. Not dividend payments, dividend raises. So as you can see here in August, right here they raised it. In August of every year they raised their dividend. So as you can see here, it went from 56 to 60, August, and then once again in August they raised it again. So this August they will be raising it again, who knows how much. But right now they're on a 48-year streak of raising their dividend. If they get to 50 years, just next year, next August in 2021, they will be a dividend king, which means they have raised their dividend 50 consecutive years. So double that of a dividend aristocrat. So one thing that I like Target is that even in a recession scenario such as this, when nobody's able to leave their homes, everybody's on lockdown, grocery stores are still open. People still need to go to grocery stores regardless as to whether or not they're in shutdown. Grocery stores are not closing down, and if anything, their sales are actually skyrocketing because people are not going out to nice restaurants. If you compare it to some of the nice big restaurants out there, some of the stocks that I watch, so like one place that I love to eat, my girlfriend does especially, is Texas Roadhouse. They've already cut their dividend, and if you look here, a couple years ago, Texas Roadhouse was an $80 stock almost, $75 or so. Now they're at 46, and they were even lower just the other day. What about a very large food company such as Darden? I've mentioned Darden in previous videos before. Darden is a stock that if you go before the recession hit, they were a $120 stock. Now they're half of that. They're 66. So when these stocks, when these food companies, these restaurants are not having people go out to their restaurants, they can't really incentivize people to come in when they can't even leave their house and they can't even sit down to enjoy a meal. So people are going to places like Target and Walmart, and I'm sure you've been to a Walmart or a Target lately, and you've seen the canned food section, or God forbid, the toilet paper aisle. It is an absolute nightmare trying to fight and get your little piece of the pie. So if you look here at Target's financials, one thing that I always like to point out is the balance sheet. So this is something a little interesting about Target. So I'll talk about stocks that are preparing for recession, stocks that are hoarding up cash, that are preparing for worst case scenarios. So as you can see over the last 4 years, it stays relatively flat. It pretty much goes up and down. They had 1 year in 2019 where it went down a little bit. They just updated this in February, so just recently, a couple months ago. It's pretty much stayed flat, right around the 2.5 billion mark, which those of you who don't know, these are all in thousands, as you can see here. So that's actually billion, not million. So they have 2.5 billion in cash, pretty much for the last 4 years. So the one thing we want to look at is their long-term debt. If you look at their long-term debt, it's pretty much the same story. It's pretty much stayed flat every single year. As you can see here, that's part of the reason why their cash was down last year in 2019. Part of that is because they paid off some of that debt. So a debt of 11 billion and cash on hand of 2.5 billion is not anything that's completely out of hand. About a 4-to-1 ratio. That's not anything that's going to take them down or anything that's super worried about. But if you look here, we're going to look at their income statement, because if you just look at their cash and their long-term debt, that doesn't give you the full story. So Target here, let's look at their revenue. The last 4 years, in 2017 they did 70 billion, 2018 they did 72, 2019 they did 75, 2020 they did 78, and especially with this year, especially going to be a skyrocketing year, that will probably be well over 80. So as you can see here, even though their balance sheet is pretty much staying the same for cash and long-term debt, their income, their revenue is going up every single year, continually. If you look at here, their gross profit. So this is what they're making in net income. They have 21 billion in 2017, 21.5 in 2018, 22 in 2019, and now they're up to 23 and some change in 2020. I'm sure that number will probably be in the high 23s or even 24 billion. That number is going to continually go up. So let's look at their dividend history here. So if we scroll down, it goes way further. Let's just go to 2000. The year 2000, this is the investor relations page for Target. They have all of their dividend history here on their website. You can see here these black numbers right here in the darkened highlighted part. It says 21 cents up to 22 to 24, 26, 30, and it just keeps on going up every single year. So just in 2000, so just 20 years ago, they're paying 21 cents in dividends, and now it is significantly higher. Now they're up to $2.60, so about 10 times that amount in 20 years. It's just a continual line up, and I'm sure they'll raise it this year in August as well. Target being such a safe long-term investment. One thing I will say about Target, there are both Walmarts and Targets all around my place that I live at, and I really enjoy the experience as a customer at Target. The prices compared to Target versus Walmart are really similar, but I think Target has more of a clean atmosphere that's more approachable for customers and is a little bit more safe and friendly environment. So I really like Target, and I'll potentially be adding this to my portfolio. They have a dividend right now that is 2.47%, so about 2.5%. It is down today, so I'm sure it'll be a little over 2.5% if I were to buy this. This stock does not have an extremely high yield. I think if it had a 3%, I probably would have already added it. I would like to see it be a little bit higher, but 2.5 is enough to get me a little bit interested, especially with a dividend raise coming in just a couple of months. Walmart stock, if we pull up here, over the last 5 years, as you can see, their dividend is very slow growth. It goes from 49 cents to just a 1 penny raise, a 1 penny raise again to 51, then a penny again, 52, 53, 54. It is a very slow dividend growth. Not only is the dividend growth slow, but also the dividend yield is about a full percent lower. So Walmart is not something that I would really want to invest in with a yield way under 2%. If it was up in the threes, maybe I would consider it. But I also like Target just for the sense when I was talking about the customer experience and their atmosphere, and I feel like their customers will be a bit more loyal than that of a Walmart. Another thing that I'd like to mention about Target that it has over Walmart, as you can see here, in the description it says with 1,844 stores as of the end of fiscal 2018. So that's a little higher now. So they have about 2,000 stores. Walmart has so many more stores than that. They have over 11,000. So when you think about the growth potential and the opportunity here, Walmart opening new stores, they are becoming more and more limited with new stores that they can open. So if you look at these older companies, so let's take Coca-Cola for example. Coca-Cola cannot really grow its Coke brand specifically. They mostly have to buy new products, put twist on old products, because they are so large already that they can't really grow anymore. Billions of people drink Coke. So in a similar situation to Walmart, they have so many stores that it's harder for them to grow. I'm sure they will be beginning to reach a peak anytime now. But with Target, they have significantly less stores and they're a lot more populated areas. As they begin to branch out and open more and more stores and enter into spaces that are competing with Walmart and hopefully dominate them, I think Target has a lot more upside potential, not only for their dividend, but probably their stock price as well over the next 5, 10, 15 years. So Target is one I'm looking at adding to my portfolio, and let me know down in the comments if you're interested in adding it. The next stock I'm adding to my portfolio, I will not dive too deep into this because I have mentioned it 2 or 3 times in previous videos, is Honeywell. I am looking at adding Honeywell to my portfolio. Over the last 5 years, they've had pretty substantial dividend growth from 52 cents to 60 to 67 to 75 to 82, and now they're all the way up to 90 cents a quarter. So very substantial dividend growth, even much better than that of Target's. And speaking of Target, compared to their dividend yield is even higher. So I've said before that this is compared to a 3M. A 3M is a company that I own. 3M has over 56,000 products, and 3M is basically just a conglomerate making so many different products that in any scenario they're pretty much going to do just fine, because no matter how many products they have that are on the decline in sales, they will always have some products that are absolutely booming in demand and some that will always be needed. So 3M is a company that I love, and Honeywell is a similar play to that. Pretty much the only negative to Honeywell is that they do have quite a bit lower dividend yield compared to that of a 3M. But Honeywell in recent years, since it's kind of stayed pretty flat, and especially with this drop since the recession hit, I think this dividend yield is starting to get pretty attractive. We're getting on the verge of 3%, and also if they follow that track of raising their dividend, they're due for another dividend raise in a couple months, just like 3M raised theirs. So Honeywell is a stock that I would really want to add to my portfolio. As I mentioned here with Honeywell's balance sheet compared to some of the other companies that I'm looking at, as you can see here, their cash and cash equivalents go from $7 billion up to $9 billion, and their long-term debt is on a slow decrease from $12 billion to $11 billion. So that is a perfect scenario for a stock that is entering a recession. They're getting financially prepared for this situation. I mentioned this in previous videos, and just like Target, if we look at the income statement here, if we look at their gross profit, it is a steady increase up from $11.6 billion up to $12.3 billion. So as you can see here, as I mentioned in some of my previous videos, these are the industries that Honeywell is involved in. They're involved in aerospace, building in cities, chemicals and materials, industrial and manufacturing, retail, safety, sporting goods, and the supply chain. There are so many different products in each one of these categories that they have. They'll have dozens and dozens or even hundreds of products in each one of these categories. So they are so diversified that I wouldn't ever really have to worry as to whether or not they will continually raise their dividend, because they have so many products that are thriving every single year. So let me know down in the comment section if you think I should be adding Honeywell to my portfolio. And next we'll get into the last group of stocks. So I'm actually going to be showing 2 stocks here because they are very similar. Their business models are almost identical, and they are both REITs. So we have EXR, which is Extra Space Storage Incorporated, and we also have CUBE, Cube. I love that ticker symbol. So CubeSmart and Extra Space are both stocks that are primarily focused on storage facilities. As you can see here, it reads here, most of CubeSmart's facilities are located in Florida, Texas, California, New York, and Illinois. For both of these, they are also in Oklahoma. I do have both facilities that are right next to me. There's actually one that is literally within walking distance of my house as far as EXR's, Extra Space Storage. So with both of these stocks, they have really similar performance, and they both have really similar dividend growth over the last 5 years. So as you can see, let's look at Extra Space Storage first since I got it pulled up. It has a dividend growth from 59 cents to 78 cents to... So as you can see, over the last 5 years, its dividend growth, it has a dividend of 59 cents up to 78 cents. And then it took about 2 years, and then it raised up to 86 cents. And now it's up to 90, and I'm sure they'll raise that soon again. So Extra Space Storage has a pretty good dividend growth from 59 cents all the way up to 90 over the last 5 years, and they have went up 35.9% over the last 5 years. So pretty good growth, especially for a REIT stock. And another thing is that their dividend yield, especially with this little light drop 1% today, they're probably right around a 4% dividend yield. So yeah, once that hits $90 even, so 16 cents away, that'll be exactly a 4% dividend yield. So comparing this to CUBE, Cube stock, over the last 5 years, they have only went up 11.81%, and their dividend growth has went from 16 cents to 21, a pretty substantial jump there, to 27, to 30, to 32, to 33. So as you can see over the last 5 years, especially these earlier years, they raised their dividend quite substantially compared to where they are now. They did raise it a little bit in the last 2 or 3 years or so, not quite as substantial as the previous years, but if you look at that dividend yield, that is 4.98%. With today's drop, that is over 5% dividend yield. That is a huge dividend yield. In comparing these two companies, one thing that we could look at is the PE ratio. Cube has a PE ratio of 28.7 and EXR has a PE ratio of 27.3. So really similar, and I know there's a lot of other ways to value companies that are REIT stocks, such as like FFO, funds from operation. And as you read here a little bit of EXR, because I read a little bit about CubeSmart, they manage about 1,500 self-storage properties in 38 states with over 100 million net rentable square feet of storage space. So diving into these companies, they really have significant amount of similarities, even their market cap. So as you can see, their market cap for like Cube, for example, is 5.1 billion, and EXR's market cap is not extremely far off, so they're relatively similar sized companies. This is 11.8 billion in market cap, so they're pretty close. So I'm trying to figure out which is the better buy. I haven't significantly dove into them yet, and I'll be doing more research in the coming weeks, but similar market caps, really similar PE ratios, and pretty close dividend yields, and their dividend growth is pretty similar over the last couple of years. So do you think I should add these stocks to my portfolio? Now, the one thing is I wish they did pay monthly dividends. It's not as good as like O stock, one of the largest holdings in my portfolio. They do pay their dividends every single month. Unfortunately, EXR and Cube do not, like most stocks, do not pay their dividends monthly. But these stocks are really appealing to me just because the reason why I like them is that they do have very sticky customers. People that have storage units, they have extra stuff that they need to store their stuff in, and they're not going to move that every single month or even very often. A lot of times they'll keep their storage units for 6 months, a year, 2 years. They don't want to move all of their crap. Let's just put it simply. They don't want to get all their stuff, get it physically moved, rent a U-Haul or a trailer, and they don't want to get it moved to a storage unit, and then they don't want to have to take all their stuff and move it to a new place. So usually the Cube customers are not going to go to EXR or any other storage unit, and vice versa. Extra storage people are not going to go to CubeSmart or anything like that. Usually they're going to look for a place, a storage unit that has a reasonable price and is preferably close to their location where they live at, and then they're pretty much just going to stay there probably as long as they need their storage. So a very sticky business. One thing that I can compare it to that is also a REIT. This is not a stock that I personally want to invest in. I know a lot of people own it because it does have an extremely high yield that is, I would say, relatively safe, is Iron Mountain. Iron Mountain is a very, very old REIT stock, and it is about the same market cap and PE ratio as the other two that I'm comparing. But Iron Mountain, pretty much what they do, they have locations where people can store their physical paperwork. They have extremely sticky customers. People will have thousands, tens of thousands, maybe in some case scenario, hundreds of thousands of paperwork and documents that they need to store for their large corporations. People with Iron Mountain who have those facilities where they store their paperwork, they don't want to leave. You don't want to move tens or hundreds of thousands of documents every year. You want to have those facilities for decades. You want to be able to have a place that is near your location, near your office, whatever, and be able to store those files, those pieces of paperwork. So do you think I should add these stocks to my portfolio? Extra Space Storage and CubeSmart both seem like really good, safe stocks that are ranging in the 4 and 5% yield, which is higher than my average in my portfolio. You can also use my link to see the dividend yield in my portfolio. So if we hit share this pie and then we hit copy and then we paste it into our web browser, it pulls up a preview of all of our holdings without showing my actual size of my position. It shows a performance of the portfolio over the last week, month, quarter, year, 3-year, 5-year. You can see the performances there. And over the last 5 years, it has went up 39.81%. But I have 30 holdings of the portfolio, and right now, as of yesterday's close, my dividend yield for my portfolio collectively is 4.103%. So about 4.1%. I have no expense ratio because I do not have any kind of funds that charge any kind of expense ratios or anything like that, or any kind of management fees. So if I were to add either one of these stocks in my portfolio, if I were to add EXR or if I were to add CubeSmart especially, that would also raise my average dividend yield. So over 4% is pretty substantial. Honestly, it wouldn't be this high if we weren't in a recession and the stock market didn't just crash, because you can see here the value of my portfolio investing $100 over the last 5 years. Just a couple months ago, it would have gained 74, 75% in the last 5 years. But now we had a significant drop with all the stocks being sold off due to the recession. But honestly, in a bear market, I want to have at least 4% dividend yield. And in a bull market, I want to have at least a 3% yield. Because honestly, if I'm not getting at least a 3% yield, then the dividend growth portfolio is not getting a high enough yield to compound that interest quickly enough. But in a bear market, I'd like to get 4% while all these stocks are at lower valuations and more realistic prices. So adding CubeSmart to the portfolio would raise that a little bit more, but I wouldn't want to take that percentage away from a company like Broadcom, for example, who I believe has a huge future ahead of them. With share price gains and dividend growth alone, they have so many different things, like I mentioned before, and their dividend yield, for example, is right around 5%. So lowering that percentage from a Broadcom, for example, wouldn't exactly help my dividend yield. One stock that I do have a very significantly low dividend yield that I mentioned before, I do not think I would lower this one just because I think the share price gains will be so huge in the future. That number will continue to go up in the future with how much of the growth potential they have there. But I will consider lowering my positions regardless of the dividend yield to fit in a couple more stocks, because I would like to have 30, but I also don't want to lower any of my positions from my other high yield stocks. So if you guys have any recommendations on which of these stocks that you think I should be lowering in my position, if anything, if you think I should keep the 30 I have now, if I'm good with what I have, and if you think I should lower it and replace any of these with CubeSmart, with EXR, with Target, with Honeywell. I know I've mentioned Honeywell in previous videos. Let me know down in the comment section. But as usual, thank you guys so much for watching. If you like watching my videos and you enjoy watching my content and you're interested in using M1 Finance, use this link down below in the description, and I have it pasted right here, and you can paste that into your web browser and you can sign up for M1 Finance yourself, and we can each get $10, and I'll put that towards my dividend portfolio, and I'll make sure to mention you in the video. Let me know down in the comment section what you thought about these stocks that I picked, if I should buy them, and anything that you'd like to ask me about the market or any future video I did. So thank you guys so much for watching, and I'll catch you next time.